Welcome everybody. I know we're mixing it up today. Usually we do our webinars at 12 o'clock Eastern time, and today it's 3 o'clock. So Chris is having his afternoon coffee. I'm lunch, basically. Wanted to test out some different times to accommodate different schedules. So we'll see how this goes. And yeah, so welcome everybody again. Thanks for joining. One house rule I just mentioned earlier for those just joining. I don't know why I keep saying house rule, webinar,
Etiquette.
yeah, hot take, I don't know, is if you have any questions, please drop them in the Q&A. Don't drop them in the chat. I won't see them. As we are going to go through the top questions that we've gotten over the past few months from investors and potential investors and members of our community. We'll probably answer a lot of them, but if we don't get to them, we do have some time reserved at the end for additional questions. So just make sure you're dropping them in the Q&A and not in the chat. So with that, I'm Lauren. This is Chris. We are the co-founders of Seveney Investments. And today we're going to really briefly touch on who we are, Seveney, and our backstory. We're going to talk about an overview of mortgage notes and how mortgage notes can generate passive income, as well as answering some FAQs. Again, a majority of this will be those FAQs that we go through, and those have been compiled from questions we get via email from our investor community and from people who are interested in investing with us. So we figured now is a good time to go through those. Again, we try to host these kind of webinars about twice a year where we're answering these type of questions. So with that, we are Seveney. We are a Virginia-based private real estate investment company, and our focus is fixing and flipping mortgage notes. And I'll walk through what that looks like a little bit later. But essentially, we have a team that has a combined 7 decades of real estate experience and have managed 5 previous note funds, each of which has exceeded commitments to our investors. But essentially, at a high level, what we're doing is buying loans at a discount, getting them reperforming, and then selling them for a profit on the secondary market. So with that, I don't think we have a slide in here, but I always think it's important to know a little bit more about who Chris is, who I am, and how we got here. So since I've been doing the majority of the talking, I will stop and let Chris introduce himself and how he and I met and got into mortgage notes.
Yeah, thank you, Lauren, and thank you all for being on here today. It's interesting because my mortgage note journey, which started over 8 years ago, like most things that are good in life, happened by accident. I was in real estate for my W-2 career for almost 20 years and started what most people do, investing passively or thinking they're investing passively by owning traditional real estate. And my wife and I were buying rental properties, fixing them up, getting them rented. And we also had 2 young kids at the time, and just realized that was your life. And we're thinking, how is this passive when we're spending our weekends literally renovating apartments? And when we decided that's enough with the rentals, what else could we look into? That's when I found mortgage notes about 8 years ago. And what's great about the mortgage notes is that truly passiveness of getting involved and understanding the differences within mortgage notes compared to traditional real estate. And as I started and grew the portfolio, we started taking on investors. And then, like Lauren mentioned, we had those 5 prior funds. And during that time, I was trying to do a lot of it myself until I met Lauren. And I met Lauren, and she can say how we met and tell that story. But ever since we have met and decided, hey, let's do this together, we've been extremely successful to grow the business to where we are at today. Lauren, I'll let you talk a little bit more about how you got into notes.
Yeah, so similar to Chris, but different. I actually went to university, was working a tech sales job in California while also volunteering for a local high school water polo team. I played in college, and so it was a way for me to continue being involved in that sport and also give back and become involved in the community. And what I realized when I was kind of helping coach was that most of the parents who were able to attend everything, I'm talking practices, games, all the things in between, tournaments that are middle of the day, was that they either had their own business they were running or they invested in real estate or both. So I was married at the time, did not have any kids, but knew that at some point I did want kids and I wanted more flexibility around that to be able to be there and active in their extracurriculars, whatever those ended up being. And so I started attending lots of seminars, lots of webinars like this on real estate investing, active, passive, looked into all the things. There was wholesaling, there was Airbnbs, there was long-term rentals. And I came across mortgage notes, and I probably read every book there is about mortgage notes. And surprisingly, there are quite a few. And what I liked about it was that you weren't the landlord, you were the lien lord. So you assumed the position of the bank. You're not dealing with like tenants who have issues in the middle of the night with flooding, faucet issues, whatever it might be. Really, I started investing in second position mortgage notes, built up my own portfolio. At that point, I met Chris, who was speaking at a conference on all the ways you could lose money investing in notes. And I was like, I want to learn because I want to learn more, because I wanted to make that transition from second position notes to first. We started collaborating, and I started helping him with his other funds. And then together we launched this most recent fund. And a little bit, if you go to the next slide, part of our journey into investing really was the passion behind this fund, because it is a Reg A, meaning it is open to everyone and there is a low barrier to entry. So really allowing and giving people the opportunity to get to play basically in a asset class that is typically in an investment that is typically reserved for ultra high net worth or family offices or institutional investors. Chris and I, with the Reg A, allowed it to be open to accredited and non-accredited, and that low barrier to entry being 5K, which is a lot easier for people when they're going and exploring options outside the stock market than thinking, okay, I have to put in 250 as a minimum investment. That's a lot for anyone. So again, democratizing those investment opportunities, making it both accessible and available to the masses. Chris, why don't you talk about what mortgage note investing is?
Yes, thank you, Lauren. And really breaking down, as Lauren mentioned previously, you are the lien lord, not the landlord. And it is an alternative investment strategy where we buy loans from other funds, banks, lenders, and mortgage brokers, which is our brokerage firms, I should say, which are typically where we see a lot of the loans that come through our portfolio. And we purchase them at a discount. And by purchasing them at a discount, it gives us more flexibility. And we'll talk about a lot of this later. And it just allows us the payment streams to come to us. Now, for anybody who's ever bought a home in the past, after your closing, about 90 days later, you probably get a letter that says, please now make your payments to ABC Bank. And that was because your mortgage was sold. Most people don't realize it, but that's actually what happened. So more than 50% of mortgages actually do get sold. So it's not something that is like hidden or not available. There's millions of mortgages out there, and many of them get sold. We just have this niche where we step in now, especially on the defaulted loans, and acquire those at a discount to work with the borrowers. Now, Lauren can talk about how we actually make money on those loans.
Yeah, so I talked earlier about how we fix and flip mortgage notes. And I like this analogy because it's something that most people can resonate with, the concept of fixing and flipping a home. We apply that concept to mortgage notes. So I'm going to walk through how that works with us. So we are buying non-performing loans secured by single family homes at a discount. So anywhere from 30 to 60% discount. Again, these are secured by single family homes throughout the US. Then really once we've acquired those, and we'll talk about what that due diligence process looks like later, as that is one of our top FAQs. There's really two paths it can take to do that fix and flip. Really 90% plus of our 95% of our portfolio goes through this top path. And I realize I always point to it and you guys can't see, but the top path being negotiating a payment schedule with the borrower. Thanks, Chris. And really how it starts out is we send what's called a demand letter once we onboard the loan. And that is the first step in the foreclosure process. While our intent is not to foreclose, what it does is it brings people to the table to negotiate with us. Now, we aren't touching interest rate. We're looking at what their arrears, their past due, typically coming to some sort of trial payment plan where they're making 6 months of consecutive payments to prove that they can do that. And at the end of the 6-month trial payment plan, we are modifying the loan. Again, all the while generating profits from those payments that they're making monthly. And when we modify the loan, what we're doing is we're either they're say paying quarterly or monthly payments towards their past due balance, or we are extending the term and taking those arrears and slash past due and attaching to them to the end of the term. We're generating those profits there after the trial payment plan. They're making another 12 to 18 months of payments. That's where we're seasoning the loan and showing that it is taking it from that non-performing status to that performing status. And so anywhere from 18 to 24 months is when we're able to then sell that performing asset back on the secondary market for a profit. The borrower will sometimes refinance. We saw that a lot during COVID when interest rates were super low, or the borrower will sell the property. In those instances, we are paid off the full balance of the loan, regardless of what we paid for it. So I think that's important to know. If it was a $500K loan and we paid $250, the loan say was paid down to $450 in the time we had it, we're owed that $450, that full amount if the borrower was to refinance or sell the property. Getting ahead of myself because that also is an FAQ we'll talk about later. The lower path here, taking ownership of the home, again, that's a small percentage of our portfolio where for whatever reason the borrower decides not to work with us, and we do go through that full foreclosure process, take ownership of the home, or it is sold at auction, more likely these days, to a third party. And again, we are paid off the full balance of the loan plus any recoverable legal fees that we may have put in during the foreclosure process. If we do take back the property, we then have partnered with an REO company where we are selling it. We're not fixing it up a lot. We're just generating profits from the sale of the property. Again, most of these have significant equity coverage that allows us to do that.
Yeah, as you mentioned, Lauren, people ask, why is that split so high? A lot of loans we look to buy are 5, 10 years old. So people have been in the home for 10 years when they may have bought the house for $250,000, where today it's worth $500,000, and their mortgage payments are less than rent. So what are their options? Move out and live somewhere else and pay rent, or try and work out a deal in your home. So this is our current.
Go ahead.
Okay, this is our current portfolio. We are in currently 24 states. Overall, we've invested in 40 overall. We currently have 56 assets in the portfolio, with the property values averaging about $950,000 per property. And you can see that our average unpaid balance on the loans is roughly about a little over $300,000. So you can see that there's a very good equity cushion on the assets. Plus our average discount is another 34%. So overall, the investment we make to value is a little over, right around 36%. Within the portfolio right now, we have a mix of performing and non-performing loans. We're a little heavier right now on performing loans versus the non-performing, which is 57 to 43. That typically flips between 40 to 60% either way, depending on loan status. If a loan is non-performing and gets performing, it'll sit in that bucket for a little while, and before we go, of course, to liquidate it. Anything else about the portfolio you want to add, Lauren?
No.
Okay. You want to talk about the experience?
Yeah, a little bit about us. Again, our team has over 70 years of combined real estate experience, and specifically mortgage note, which is, as you can imagine, a super niche asset class. We've done this individual fix and flip process over 600 times and have never missed a scheduled distribution or lost an investor's principal investment. Total disclaimer down there. Past performance is not a guarantee of future results. And then from a track record perspective, we have had 5 funds go full cycle, meaning they have opened and been fully liquidated, and that has returned an average weighted IRR to investors of 14.5%. Yep.
One thing I'll mention is we did have a verification report done on those. So that's where a third-party company looked at those funds, similar to a Morningstar rating, where they'll look at, how much does this fund actually provide to investors? We had a third party. That's not our number. That's the number that came from this third party report.
And then this is really that offering. Oh, I think this is that offering that we were talking about. So Chris and I go through these slides, just a side note we go through these slides and, hey, let's flow. Who's going to take what slide? So I accidentally jumped in. This was Chris's slide, but I'll keep going.
You've done this one every other time, and I'm like, hey, let me just
I
take this
thought,
one because, as you can see, there's, it's a very simple slide.
yeah. So really it's like I mentioned earlier, it is open to accredited, non-accredited investors. So basically anyone can invest. The term is 4 years. At the end of 4 years, you can request redemption or leave the funds and request. Think of it like going month to month on a lease. You can request at any time. It doesn't lock up for another 4 years. The minimum investment is $5,000. We do start offering bonus shares at $25,000, and the preferred dividend is 8%. So 8% annually, paid as monthly distributions.
One thing I'll just add to this, Lauren, is that 4-year lockup, whereas something to look into after that 4 years happens, again, as you mentioned, 4 years, one day the person can redeem or they can keep it in there. It doesn't auto renew. And we can do that because it's not one asset in our portfolio that we have to liquidate. We've got lots of assets in our portfolio that gives us the liquidity at that point in time to allow investors to redeem.
Some of the highlights of the fund, it is open to both qualified and non-qualified accounts, so basically cash or self-directed IRA accounts. We do pay those dividends monthly. No leverage in the funds. Again, we'll talk about this later and why this is important. We do seek up to 4 times collateral coverage. So when people ask, okay, what if housing prices drop drastically? That's where that equity coverage is super important and something that is part of our evaluation process when we're looking to buy assets. It is not a blind pool. There are just under 60 assets. So it's not like we're raising capital for this shiny development project we're talking about. We actually are raising capital and deploying it on a monthly basis. There are no fees. Again, we will talk about that a little bit later. I'm trying not to get ahead of myself with the questions, so we're not repetitive for you guys. And then from a tax perspective, it is a 1099 dividend, and there may be some tax alpha there, but as we are not tax professionals, it's really unique to each individual's situation. So definitely check with your CPA on that.
Yeah, and it's an important question for people who invest in debt funds to understand, am I getting a K1? Am I getting a 1099 interest, a 1099 div? Each one has different tax ramifications. So it's make sure to understand that and talk to your advisor. Okay, now.
So here's where we've compiled, again, probably the top FAQs, although now I can think of probably 10 more that as we went through that we could have added that we've received from our community over the last 6 to 12 months. So we'll go through these again. If you have questions, drop them in the Q&A. And if we don't get to them, we'll answer them at the end. We do have time for that. So some of the top fund questions we're getting: has Seveney had other offerings in the past? How did they go? How long will the combination of businesses stay in business? CWS as the entity plans to stay in business indefinitely. This fund, unlike the others, is an evergreen fund, so it's not closed. The other funds, we've had 5 offerings go full cycle and have never missed a distribution to an investor. Bonus shares, we get a lot of questions around the bonus shares. I mentioned those start at 25,000. Someone asked if there's a limit to shares and how many bonus shares do you get at each tier. It is a percentage, so it's not at 25,000 and 49,000, you're getting 100. It's you get 4% bonus shares between 25,000 and 49,000. At 50, you're getting 5% bonus shares, 100, 6%, and 250, 7%. So what this looks like and the kind of the impact is, for example, if you're investing $100,000, you're going to get 600 extra shares that you will, one, accrue 8% on, but also be able to liquidate for the cash value at the end of the term. So really, each share is worth $10. That 100,000 that you invest, you're actually going to accrue 8% on 106,000, which bumps up your annual return. But then at the end of the term, you're able to redeem that extra request redemption of that extra 6,000 as well, which bumps up your total IRR to that 9.77 pictured there. So there isn't a limit on bonus shares. However, each investment is looked at as unique. So it's if you invest, say, 50 and then you invest another 25 or another 50, you're not at the 100 tier bonus share. Each would get the 50. You'd be at that 50 tier for each of them. So it's looked at as unique, not cumulative. Management fees and how we get paid. Great question. So we don't take any management fees. We are salaried employees of CWS. We only win if our investors win. So our profit, our win is on the upside after investors are paid.
And people ask, what is our distribution history? As we've mentioned previously, we haven't missed a distribution since the inception of this fund, as well as, again, our prior funds. And we do have to caveat past performance is not indicative of future success. Next question is, where do I invest and how do I know that you have invested it? First is you can invest on our website or directly book a call with Lauren, and you will receive access to the portal. Now, the question about how do you know we invested it, one of the things about a Regulation A offering compared to, say, a Regulation D offering is the reporting. And Regulation A offerings require us to get qualified by the SEC, meaning they have reviewed it, they don't provide investment advice, but it meets a lot of their criteria to allow us to raise the money. As part of that process, we have to submit financial information to them twice a year and any updates on the fund as well. So that's one thing about how you can also check overall on the company, but also just you can reach out to us. Our investor relations team is internal within the company, so they know everything that is going on. And Lauren, do you want to talk a little bit about self-directed IRAs?
Yeah, so someone asked about, are there advantages? Do you accept self-directed IRA funds, which are qualified funds? The answer is yes. We do accept funds from self-directed IRAs, solo 401ks. You just have to be with a custodian that allows you to direct into an alternative asset, basically something that is not a stock or a bond publicly traded. There's a lot of custodians that allow you to do this. If this is something you're interested in, feel free to reach out to invest at Seveney Investments, and we can point you in the direction of a few custodians that we've worked with if you're looking at opening a self-directed account. How much have we raised since the fund launched? So we've raised 30 million. 20% of our investors have reinvested, and we have over 700 investors. Are there any third-party firms that regularly review Seveney for compliance and confirming assets held by the fund? Great question here. I also think Chris touched on this on the last slide, that we are a Reg A, so we are held to a higher standard on everything we do by the SEC. So we have Grant Thornton as our auditor, and they submit annual audited financials and semi-annual unaudited financials, which are public accessible on the SEC website. You mentioned you don't use leverage in your fund. Does the offering circular prohibit you from using leverage? Are you legally allowed to use it and just choose not to? So great question here. Again, the offering circular does not prohibit us from using leverage. We cannot exceed 70% leverage on an asset, and we're just choosing not to at this time. And we have it in our 5 previous funds. Can I reinvest my dividends automatically? This is a great question. I keep saying this is a great question. This is the question we get a lot. Unfortunately, at this time, we don't have a dividend reinvestment program. However, investors can make additional investments as long as that 500K or 5K minimum.
As Lauren mentioned earlier, the required holding period for the investment is 4 years. If somebody does require a redemption, there is a redemption policy in place. There's typically penalties imposed. First, we are not obligated to provide a redemption, but if it is considered and approved, there are penalties, which we have different percentages on. There is no penalties on a death or a permanent disability. So there is a clause within the offering about that. And I recommend people to just read the redemption policy that is in the offering to gather more information on it. And then for those, when you do want to redeem, there's no justification required after the 4 years. You just fill out the redemption form, and it could take up to 90 days to get that redemption processed. There's some paperwork that has to be executed. We use a third-party transfer agent called Securities Transfer Corporation, and they are the holder of the shares, so they also have record of the cap table. Anything else you want to add on that, Lauren?
Nope.
For strategy and due diligence, the mortgage fund, or are there other strategies? And we are focused on mortgage notes. Lauren talks a lot on webinars that we are not chasing that next shiny object. Over the last several years, short-term rentals, self-storage, midterm rentals, a lot of real estate asset classes, what I would deem as shiny object syndrome or FOMO, fear of missing out. For us, we are investing in mortgage notes, and that is our focus today. That is our focus a year from now and for the future. We do not see us moving off of that at all. And part of the reason is the next question is, where do we source our deals from? And as mentioned earlier, Lauren and I have been in this space for 8+ years, and we built a lot of relationships over that time. On average, we see several $1 billion a quarter of assets. So when we're buying millions per quarter and we're seeing billions per quarter, it allows us to cherry pick or be very selective on the assets that we had. We also just don't have one source. So if that source were to something happen to them, we have over 30 sources that we source deals from. And we've mentioned this earlier, but the average discount for the loans we purchase is, again, it averages about 30 to 60% is a discount. Sometimes it might be a little higher, sometimes a little lower, but that is that average. And we mentioned prior about the 24 states that we have been in. What criteria do we use to do due diligence? We talk about this a little bit more, but from the property standpoint, in the loan, we look at a low to moderate crime area, properties values greater than 100,000, balances of a loan above 50,000, but we always base our bid off of specific returns based on exit scenarios, and we'll talk a little bit more about that later. Talk about that more later because one of the questions we get to talk about is interest rates, which we'll mention.
Yeah. So diving into the due diligence, because this is a question that we get a lot. It's not like we're just bidding on loans, even if we are looking for a specific yield, which again, Chris will mention in a little bit and talk about that process. But there's really a deep due diligence that goes into the property, the person, and the predicament. When we're putting in that indicative bid, it's really based off of the information that the seller is providing on a glorified Excel spreadsheet, essentially. Once our bid has been accepted, we enter into a due diligence period, an escrow period, I guess you could call it, where we're doing research to verify the information that was provided. From a property perspective, we're getting a BPO, making sure title is clear, the structure is actually there, the condition of the property, that it's actually a first position note, if it was listed as a first position note, that the borrower is actually the borrower. So looking into all aspects there, having it reviewed by legal as well to make sure it's collectible. Then we look at the person. We're running a skip trace, looking at criminal, financial history, mortgage payment history, and that really leads us into the predicament. Something that I think we do really well is looking at the prior servicing notes. So digging into what the communication has been like between the prior servicer and lender and the borrower. Typically what we're able to find is that there was some life event that caused the borrower to stop paying, whether it was job loss, death, divorce, a health issue, or something situational. Most 99% of the time, people just don't wake up and say they're going to stop paying their mortgage. And so we're able to see what is the borrower's ability and desire to get back on track. And was this something where they were out of work and now they're back in work? Was the lender, many times, I'm sure Chris has many stories about this, where the lender just did not have proactive outreach to the borrower, and the borrower was trying to actually get back on track and the lender was non-responsive. So there's a lot of things that we can really take from the servicing notes to see if this is a loan that we feel we can get back on track. So anything to add there, Chris?
No, covered it well. So as we mentioned on the prior slides about how we bid, one of the most common questions we get asked is about interest rates, because everyone thinks mortgage notes, interest rates, they are extremely correlated because everyone's trying to get the lowest rates on their property or how it's impacted. For us, it actually isn't a big deal on the mortgage rate environment because we're buying the loans where they're already at a fixed interest rate. And we bid off of a yield, and we have an example at the bottom that if we're targeting a 12% yield, a loan that's at 8% would be less discounted than a loan that was at 4%. So we would acquire a loan at 8%, we'd pay a little bit more for that loan and still get a 12% return versus a loan that, say, was at 4%. So the interest rate environment really does not have a significant impact on us directly. Indirectly, as Lauren mentioned earlier on, during COVID, we were seeing a significant uptick in refinances. And that was because rates were so low. When rates are lower, we do see a greater increase in refinancing compared to where rates are at today, of course. And that other question about if rates, do fall in the distressed loan market, how do we leverage the phenomenon? And one of the things that we have done in the past is offer borrowers a refinance and possibly pay their closing costs, as an example. If there's a loan that was reperforming that, say, it would sell at 90 cents on the secondary market, if we offer them a 5% discount to refinance it, well, we'll give them the discount and give them the 5% off because it's better for us, our investors, and the borrower than it is to sell it at 90 cents on the dollar. So we've got many different strategies in regards to what happens during these times that we can implement.
So risk adjustments, what safeguards does Seveney have in place that will protect investors? So we look at, again, the collateral is the property. So we're looking at the title, the tax. We do have insurance on the properties as well, the property value, so the equity in the property. But we also like to point people to our due diligence webinar we've hosted before. It is on our website. It's a great resource that talks about all the safeguards in place when it comes to that property being the collateral and the equity. And we'll talk a little bit more about this equity here in the capital stack here shortly. So Chris, you
Yes.
wanted to take the front?
So what sleeps me up at night? Thankfully, my kids are older and I don't have newborns like my sister-in-law does. But for us, it's really the economic conditions. Now, we mentioned interest rates aren't as much of an impact, but inflation can have a non-correlated impact because it may impact job loss. And that's one thing that we constantly look at is job loss and where is that headed? Because, for example, right now, whether my property value or interest rates go up or down, or property values go up or down by 25,000, it's not going to really impact me. But if someone in my family lost a job, that would have a bigger impact. So that's one thing we monitor. The other is state regulations. So every state has different foreclosure laws, and we stay on top of that on a daily basis. I was actually on the phone earlier with the webinar in regards to our attorney in Pennsylvania. We were just talking about some things that were going on in Pennsylvania. So we have a minimum 2 attorneys in every state that we're constantly talking with, because states could have an impact if they have a change in laws that could have an impact on our portfolio. Let's see, and then what are some of the capital loss scenarios that Seveney could face in the future? Foreseen circumstances, what needs to arise to not make a monthly distribution? So one of the things I want to mention about this is early on, about a year and a half ago, Lauren, was it, when we had what's called a fact right report done on the company? Mm-hmm. And it's a third-party due diligence report that analyzes the business structure, what we invest in, and really the risk involved. And things come out of that. For example, we have insurance on Lauren and I. We have key person insurance for the fund in case something forbid happens to one of us. So that's a common question people should ask, is what happens if something happens to one of your sponsors? Right now, we don't have any leverage or debt. So I know people may have invested in other multifamily deals that are underwater, or the rents weren't coming in and they missed their loan, so a bank came in and foreclosed. That's not a situation or scenario that we see. As I mentioned, what keeps us up at night, circumstances that arise goes back to state laws or things that could happen within the portfolio. Or the other thing is if capital could not be distributed. But as I mentioned earlier, we're seeing billions of dollars of loans coming to us every quarter that we get to pick and choose from. And we'll talk a little bit more about that, but also the capital stack. We'll mention that as we have a better slide as well. Which here is the capital stack. So in a typical capital stack, the lower you are, the quote better place you should be. And usually it goes senior debt, mezzanine debt, preferred equity, and common equity. But for us, we don't have that senior debt or mezzanine debt. So throw that out. Preferred equity, which is the investors, are first in the capital stack. So I had a call with somebody earlier today. They were asking about the fund. And they said, if somebody said to you tomorrow, you had to sell all of your assets, where would that money go? And outside of a few bills that the company has and our payroll, money would go to the preferred equity holders. Again, there's not a $20 million loan against the company. There's no other guarantors that would get paid. It would go right to the investors. Anything you want to add to the capital stack, Lauren?
No, I think this is something that's really important that a lot of people should be thinking about, especially in kind of today's market where we're coming off of really low interest rates over the past several years into today's interest rate environment. Again, the focus on leverage is important and where you are in the capital stack if someone takes out a loan.
Yeah, and the other thing too that I'll mention is because we don't have debt or debt obligations, and I don't know if this is an FAQ, but people ask, have you ever done a capital call or a need for a capital call? We have never done one. And also, we don't have debt. It's not like we have to pay Capital One or Bank of America or somebody every month for any type of loan payment. We talked earlier about the investments in the equity, and the average property is around $1 million with a loan around $350,000. Here's an example of smaller scale, a $250,000 property that has a $100,000 loan balance. And again, loans that are 10 years old, this is a pretty easy run-up standard kind of scenario in today's environment, because loans that are 10 years old that they may have bought the house for 150 and finance 120. Yes, you don't pay off a lot of the loan over time, but that property appreciation has been significant. So when we then tap into the fact that we're purchasing that at a discount, in this instance, a non-performer in a foreclosure state, we buy it 50 cents on the dollar. Again, that investment to property value or investment to collateral is, in this instance, 20%. There's a $50,000 investment we made that's secured by a $250,000 property. And I know a lot of people sometimes will look to invest in notes, might be, oh, I might go own or finance a property to somebody. But in a lot of those instances, they're financing $225,000 on a $250,000 property. So it's just a completely different risk profile. Anything else about the equity, Lauren?
No, I think this is like when we talk about like risk mitigation and collateral coverage, I think this is really important to show and highlights an example of how secure we feel in the investments that we're making because of the coverage that they have.
And we've already talked about this, so we just want to again show it again about the exit strategy. And go ahead. Go on ahead.
Yeah, I just think that it's unlike some other funds or asset classes. There's not one exit strategy that we're hinged on. This has to happen. There's multiple exit strategies, multiple ways for us to work with the borrower. And I think that allows us a lot of flexibility. So again, we talked about what some of those are, and the fix and flip kind of strategy is the overarching strategy, but there's several ways to do that. When we get a loan performing and seasoned, what is the average discount UPB you sell a loan for? And how do you determine? So really that depends on a variety of factors, like and it's similar thinking about us buying the loan. It could be anywhere from 75, 80 to par, meaning full price, depending on the borrower's credit score, value of the property, LTV, all of those things. So again, similar to us, if we were bidding on a performing asset, what would that look like?
Yeah, and we always will look to target the sell loans, of course, for a greater price or a lower yield than what we can buy them for. But that also is typically the case because we're buying in bulk. We're Costco shopping versus people who are shopping at the local store. That's only buying a one-off thing. By buying in bulk, that allows us a lot of times the benefit to get a little bit more of a discount. And again, some of the exit strategies, what ability you have to stop losses if it's in a loss or decline. One of the things that I think is a differentiator for our company is the amount of attention we pay reviewing our loans. Our asset management is in-house. We have different people looking at these loans. We're meeting at least once a week, having conversations on these loans and trying to play out the different exit strategy scenarios. For example, we have a loan right now that prior to this call, I had the paperwork sent over to me for a negotiated settlement we have with a borrower. And it was a borrower who was trying to drag out a foreclosure filing, and they were successful in dragging it out and probably could still, based on where it's located, drag it out for another year. Instead of going through this process and waiting another year, which who knows, home prices could go down, something could happen. We don't know. There's unknowns. We struck a deal with the borrower today. That is a win for us. You know, he's going to win on the deal as well, but it's a profitable investment and allows us to do that risk mitigation to avoid any potential losses. And that's one thing from my background of being in real estate for 25 years. I'm very risk averse and will always make sure that we're not putting any additional risk on an asset. If we can get out of an asset and still do well on it, I'm happy to do that. We also, question is, if you end up taking over property, can you share more about the process when selling it on the market? How long do we hold it? Can you share more information about the REOs? So we typically, as Lauren mentioned, we hire a third-party company that can assist us in changing the locks, getting it clean, getting the trash moved out of the property, cleaning it up a little bit. It's extremely rare that we would ever go in and do any type of rehab to a property. And 500 or 600 plus notes, I can count on one hand how many loans we've actually gone in and did more than trash out on. And again, we sell them through an agent. It's not like we're just selling them off market to a wholesaler. We want to get top dollar for these assets. So we will get a real estate agent who specializes more in real estate owned properties to list this property and get it sold for us. Over the last several years, of course, with a lot of equity in the properties, a lot of them would sell at auction. So it's really rare that we foreclose, and it's even rarer that we actually take one back. But when a mortgage gets paid off, we get paid. We issue them a letter saying, hey, your mortgage is paid off. And we'll take those funds and go back and invest in a new asset. Getting paid off on a note is the best exit strategy because you're typically getting paid everything that you're owed. You're not having to sell it at a small discount. Then the question that people ask, and when people say no to this question, I scratch my head, but have you ever lost money on a loan? Of course we have. We've done over 600 deals. And every time we do, again, the numbers of deals we've lost loans, I think in this fund right now, we peaked at about 150 assets. So we've probably been through close to 200 assets. I think it's under 5. And the biggest loss on a loan was a few $1,000s on a loan, which again goes to show that top question about our stop loss on investments. Anything you want to add, Lauren?
No, I think when it comes to have you ever lost money on a loan, I think our strategy is not to always aim for grand slams. It's funny, I'm not a big baseball watcher, but my husband is, so this resonates with a lot of baseball fans. Our goal isn't to hit grand slams every time. It's really to hit singles, doubles, and triples and mitigate striking out. So again, we are pretty risk averse, pretty conservative in our processes and how we approach assets and management, but I think that's important to know. We're not going to promise that every time we'll hit a grand slam.
Yeah. And from a percentage standpoint, it's 97% of the time it's a successful loan.
So I always offer this up there. So this is a link to book a call directly with me. I know you can also speak to members of our team, but for those attending this webinar, this is a offer to book a call with me, ask any follow-up questions you might have, learn a little bit more about us, our team, our company, the fund. I will also drop the link. I know sometimes I have struggles with scanning QR codes, so I will actually in the chat drop a link to that calendar, which would take you to my calendar to book some time. We did get some questions as we were going through this, so we'll leave this up while we go through this, but someone asked, can I invest from 2 sources of funds to get to 50,000? For example, 25,000 from a self-directed IRA and 25,000 from savings. Unfortunately, no, it has to be a single source of funds to hit those different bonus share tiers.
That's actually more of a self-directed IRA issue because your IRA is fitting from your personal cash. Okay.
If your investment ratio to house, it says you're in the homeowner takes a HELOC, are there any limitations on the max the homeowner can take? I think this is a great question because it talks about lien position. And I mentioned earlier that I actually started out investing in second position liens. Most of those were lines of credit, HELOCs. And so when I was doing that, I always had to look at, okay, is there enough equity to cover the first and my loan, my HELOC, which is typically a second or third position loan that falls secondary. So for example, one of the questions we just answered was if the house gets sold, refinances, loan gets paid off, how does that work? So that's where lien position matters. So majority of our loans are first position liens we're investing in. So we talk about that investment ratio. That's really not a factor in us getting paid off because we are paid first. If the homeowner decides to take a HELOC out and that HELOC is in second or third position, they get paid if the equity is there. We get paid first if the homeowner sells. Chris, do you have anything to add to that?
No, you've hit it nail on the head. We're primarily in that first position, so we're getting paid first. So now typically lenders, or if they're going through a bank, they typically today might get up to 70, 75%, but that would not have any impact. Where it actually helps us is if we go to foreclose, the second will usually bid our payoff at auction because they don't want to get wiped out. Because if we are owed 300,000, and let's say there's a second owed 100,000, we might bid 300,000 at auction, and if it's sold for 300,000, that second lien gets zero. That investment just lost $100,000. So they would typically bid to protect their interest, and we would walk away with all our cash, and they can deal with the product.
Now you're wondering, why would Lauren ever start with second positions? That's a question you can ask me if you book a call. No, for me, I did second position liens because I could mitigate risk in that I could get a lot of smaller loans, make sure there was that equity coverage, and kind of learn the processes of how to fix and flip mortgage notes. Another question, do you have something like a prospectus that can be sent via email? Yes, we do have our offering circular that we can send you. Again, feel free to email us at invest@seveneyinvestments.com and we can send that to you. It's similar to a PPM. If you're used to investing in a Reg D offering, it's the kind of offering statement. Can you address the 8% annual versus the overall return of 14.5? Yes, I had a feeling this question would come up. So when I was talking about the 14.5, I was talking about the previous 5 funds, not this current fund. So that was the overall return of the previous 5 funds. And one thing to note there is they were structured a bit differently. Think of those as those were our newer funds. Those were times when we were first-time sponsors. So we were giving up a lot more. We were doing different structure in that it wasn't just a straight preferred return. It could have been a preferred with some upside. So that's why that return is 14.5 there. So it's not on this fund. It's on previously closed funds as a whole.
2 other things I'll mention is the risk profile in those funds were a little bit different. There was a much greater weight to non-performing loans in those funds. And also just overall in real estate returns have gotten compressed over the last several years based off of the economy.
Why do you think only 20% of investors have reinvested? So actually, and I will give a shout out to our director of operations, who is a stats and data wizard, but actually the reinvestment range is typically 50 to 30% for 15. Yeah, the range.
Yeah. I thought you said 50.
No, 15 to 30. Yeah, good call. 15 to 30% between private equity and income funds. So we're really in a good spot at that 20%. One thing would be that we actually also have entered the broker dealer space. So we're working with financial advisors and RIAs. And so we get a lot of new clients from there, but it has diluted that. Again, we have over 700 investors. So we're not saying the amount of money reinvested. We're saying over 150 investors have chosen to reinvest. A lot of those multiple times. We have a few investors who invest every month in the last week of a month. I don't necessarily think that's low. I think it's just a matter of how many investors we have, the type of avenues that we are getting capital from, again, working with Schwab, financial advisors, and RIAs. and bringing new clients through the door to grow our client investor base. So anything you want to add there, Chris?
The only thing I'd add is also with a low minimum of $5,000 investments, there's people who just can't afford to, or they want to diversify with, when typical in our Reg D prior funds, the reinvestment rate from one fund to the other, or even into this fund, is very high. It's, I think, over 50+% of people have continued to invest with us over a period of time. Like you said, 20%. When I look at that number, I think that's a great number and falls right in line with what a lot of is out there. Yep.
What's the percentage of secondary loan sales of performing loans to
REOs.
sales?
Yeah. Again, we have very minimal foreclosures on our books, and then taking a property back is even rarer. Again, out of the probably 150 to 200 assets that we've had within the fund, I think there's been maybe, I don't know, 5 to a little more that have been REOs that we've had to sell. And again, there's a few in there that we knew as we bought a pool that the borrower was deceased, so we knew those would actually be foreclosed upon. But if the main question is how many loans do we work out versus foreclose upon, we're very successful over the last 2 years in being able to get people to reperform on their loan. And that goes back to that due diligence process Lauren mentioned about going through the servicing notes, understanding what the borrower's predicament is, understanding whether a borrower's filed bankruptcy 7 times or has never filed, because that makes a difference where if somebody's filed 7 times, they're a professional borrower, which is a term like a professional renter, or people who just squat in houses and live there for a long period of time till they're finally told.
We don't have any more Q&A. If anyone wants to drop anything in or has any last minute questions, happy to answer them. If not, know that we will send a recording of this to all those who registered. So if they registered and you had to leave early or you joined late, don't worry, we will send out a recording of this. Again, if you're interested, I did drop my link in the chat, so feel free to book a call with me and I can answer any additional questions that you might have. We did just get another question. I'm a full-time realtor and have been seeking investment opportunities locally. Would you do a consult with the lead I provide and possibly offer it with me to sell the property afterwards?
Yeah,
that's a question, Fred, that we'll have Chris follow up with you on. That's not typically something, again, that we do. We are very focused on our asset class and our strategy, but
we're always helpful to provide people. We don't have an answer for you. We can tell you where to go to get an answer or find a person.
Yeah, and one thing I wanted to touch base on, it popped into my head when you were answering the question about REOs and why we don't take a lot of them back, or why we don't have many REOs, is because, think about it, in this economic environment, it's hard to buy a house as it is. If you're an investor looking to go to foreclosure auction, you're going to get a deal on a home that you probably could not buy with regular financing. So if you have the ability, we see a lot of investors coming in and bidding on these assets because they're getting great deals. And for us, it's irrelevant as long as we're getting paid the full balance of the loan. That's why we're not, in this economic climate, taking a lot of assets back. Any other questions? If not, I will go ahead and end it here. And thank you guys so much for joining us today. Again, keep an eye on your inbox for the recording. And as always, feel free to reach out with any questions. You can reach us at invest@seveneyinvestments.com or book a call with me or a member of my team. Thank you.
Thank you all.
Happy Wednesday. Bye.
Bye.